So after the financial crisis, Congress determined that banks with more than $50 billion in assets, this is about the roughly 40 biggest banks in the country, posed a greater risk to the economy than community banks and credit unions. And so we required the Federal Reserve to apply tougher rules and more oversight to those banks. And now those banks want to eliminate the $50 billion threshold. They want to cut all but the very biggest banks loose from stricter oversight. And they want to restrict the federal regulators from applying tougher rules except under somewhat more limited circumstances. So in other words, this is about rolling back a big part of Dodd-Frank. And I just want to take a look at that. Mr. Simmons, you're the CEO of Zions Bank, which is one of the banks that would avoid tougher rules under the industry's proposal. And in your written testimony, you argue that the current approach covers too many banks, given the minimal risks posed by banks like yours, and that we're unnecessarily making it harder for banks like yours to lend. Do I have that about right? Yeah, okay. Now, those arguments sounded very familiar to me, so I went back and looked, and it turns out that back in September of 2006, just 2 years before the financial crisis, you were the head of Zions Bank, and you testified before the House Financial Services Committee. Your testimony strongly opposed guidance from federal regulators that increased the oversight for banks that had a high concentration of commercial real estate loans. Regulators were worried that the banks were overly exposed to one category of lending, and that might put them at greater risk of failing. You thought, there's no problem. And in opposing the guidance, I want to quote you on this, you said, the guidance has been proposed at a time when the banking industry is exceptionally healthy. Another one from you in this testimony, commercial real estate loans in particular have performed exceptionally well. Another one, by using blanket industry-wide guidance to address concentrations, the regulators risk choking off the flow of credit from banks that are engaging in commercial real estate lending in a safe, sound, and profitable manner. Now, within 2 years of your testimony, the bank you led, Zions, needed nearly $1.5 billion in taxpayer bailout money to stay afloat. And here's the kicker. That was in part because your bank was highly concentrated in commercial real estate lending, the exact thing that you told Congress was not an issue, nothing to worry about. So, Mr. Simmons, when you say today that Congress can safely roll back the rules on banks like yours and there won't be any risks to taxpayers, why should anyone believe you?
Well, listen, what we're saying is that the enhanced prudential standards in Section 165 of Dodd-Frank are industrial strength and intended, in my way of thinking about this, for institutions that pose...
Mr. Simmons, let me stop you right there, because I know we're really trying to do this quickly. I'm not asking you to repeat your argument. We've already agreed on what your argument is. The question I'm asking, given your previous testimony about how there's no problem here, and then it turned out you needed $1.5 billion in bailout money on exactly the thing you testified was not a problem, I'm asking why anybody should believe you when you come in here today and say, no problem in this area, let the $50 billion and above banks go ahead. I'm just trying to understand why you have any credibility on this issue.
Well, listen, because I deal with it every day.
Well, you dealt with it every day back when you testified in 2006, and the taxpayers had to pony up $1.5 billion to save your bank.
Listen, every large bank took TARP money.
So your argument is that you were right or wrong?
No, the one large bank that didn't receive it, National City, was sold a week later. This was a matter of preserving confidence across the industry. Our capital, our equity capital, always remained above the regulatory minimums.
I'm sorry, Mr. Simmons. Are you trying to make the argument that you didn't have a problem? You know, because actually...
We encouraged stress, but we never saw equity capital, common equity capital decline below the regulatory minimums.
The regulators actually went back in 2013 to re-examine their earlier guidance, the guidance you'd said was unnecessary, and they found, quote, during the 3-year economic downturn, banks with high commercial real estate concentration levels proved to be far more susceptible to failure. Specifically, 23% of the banks that were highly concentrated in commercial real estate lending, what you had testified about, failed, compared with only 0.5% of the banks that weren't. So I understand we're out of time. I just want to say here, what I notice about this is whenever things are going okay, the banks come in here and say, yay, let's reduce the rules, let's let everybody go out. What could possibly go wrong? And then when things go wrong, banks like yours line up and say to the taxpayers, bail me out. Our job is to make sure that we do not permit the next failure to happen because it helps short-term bank profits. Our job is to watch out for the taxpayers and the security of this economy.